Look at a massive multinational corporation. On paper, it might be fractured into hundreds of legally separate companies scattered across the globe, but in reality, it operates as a single, coordinated machine. To evaluate a structure like this, accountants rely on a principle called substance over form. This principle dictates that the economic reality of a transaction must determine the accounting treatment, regardless of the legal boundaries. The clearest trigger for treating two entities as a single economic boundary is the voting interest entity, or VOE, model. A VOE occurs when one company holds direct or indirect ownership of more than 50% of another company's outstanding voting shares. Control can also exist without majority stock ownership. Under the variable interest entity, or VIE model, control is established through contracts, where one entity has the power to direct the activities of another and absorbs its financial risks and benefits. Legal separation means very little to an investor if a single parent entity dictates the management, risks, and policies of the entire network. If one entity pulls the strings, the financial statements must reflect that unified control. Imagine Entity A and Entity B operate under the exact same economic umbrella, but they maintain entirely separate ledgers. If an investor simply added their separate income statements and balance sheets together to gauge the size of the overall business, the result would be wildly inaccurate. Combining the raw statements double counts any revenue generated when Entity A sells to Entity B, and it artificially inflates the total assets of the firm. To prevent this distortion, companies must use the acquisition method. This is a rigorous mathematical framework required to build a truthful consolidated financial statement. Preparing consolidated statements involves adding the parent and subsidiary accounts together, but the real work of consolidation is a systematic process of subtraction to erase those internal financial illusions. The first step of the acquisition method requires the acquirer to measure the consideration transferred, the purchase price, at its exact fair value on the acquisition date. When a parent acquires a controlling financial interest in a subsidiary, 100% of that subsidiary's identifiable assets and liabilities are brought onto the consolidated balance sheet. Often, a parent company pays a purchase price that is higher than the measured fair value of those identifiable net assets. To keep the accounting equation balanced, a specific asset called goodwill is created. Goodwill acts as the mathematical plug to account for the premium paid over the value of the net assets. Goodwill represents future economic benefits that cannot be individually identified and separately recognized, such as a strong brand reputation or specialized intellectual property. If the purchase price is actually lower than the fair value of the acquired net assets, the acquirer recognizes a gain from a bargain purchase instead. Calculating goodwill or a bargain purchase gain ensures the consolidated balance sheet captures the true cost of the combination while maintaining the fundamental accounting equation. A mechanical paradox arises when a parent company acquires control but purchases less than 100% of the subsidiary. A common assumption is that the parent should only bring over a proportional 80% of the subsidiary's assets and liabilities to the consolidated statement. Because the parent exercises full operational control over the subsidiary, 100% of the subsidiary's assets and liabilities must be reported on the consolidated balance sheet. Here is the assets section of a consolidated balance sheet. Consolidated assets are calculated by combining the parent and subsidiary line items. To reach total non-current assets, the excess fair value of land and the newly calculated goodwill are added directly to the baseline. To account for the 20% of the subsidiary that the parent does not own, a single line item called non-controlling interest, or NCI, is recorded in the equity section of the consolidated balance sheet. NCI represents the portion of equity in a subsidiary not attributable directly or indirectly to the parent company. The NCI mechanic allows the balance sheet to display the total operational scale of the entity to creditors, while strictly walling off the equity that belongs to minority shareholders. Consolidating entities routinely conduct business with each other, buying and selling goods across their internal borders. A single economic entity cannot recognize profit by doing business with itself. If a parent company sells inventory to its subsidiary at a markup, the parent records a profit on its separate standalone income statement. If that inventory remains sitting on the subsidiary shelf at year-end, The profit recognized by the parent is entirely an internal phantom. A specific year-end journal entry must be made to eliminate this intra-entity gross profit from the consolidated net income. This same elimination entry simultaneously reduces the subsidiary's inventory account back down to the original historical cost it had before the internal transfer. This extinguishment logic also applies to intra-entity loans and reciprocal dividend payments, which must be completely eliminated from the consolidated reports. This elimination engine acts as a critical filter. It strips away internal friction and ensures revenue is only recognized when goods are finally sold to outside parties. Once the balance sheet is constructed and internal transactions are eliminated, the final operational results are tallied on the consolidated income statement. The final mathematical step is splitting the total consolidated net income between the parent company's shareholders and the non-controlling minority owners. Total consolidated net income is $65,000. We extract the minority share by multiplying the subsidiary's $26,000 separate income by the 20. An entity could manufacture artificial sales growth by shipping the same inventory back and forth between its own warehouses, logging each transfer as new revenue. Consolidation accounting is an essential reality checking mechanism designed to stop these corporate shell games and reveal the actual health of the business. The acquisition method and the elimination engine require complex, meticulous accounting, but their mathematical rigor is indispensable. This process forces the final reports to reflect genuine external liquidity, solvency, and operational performance. Legal classifications, whether they are LLCs, C Corps, or international subsidiaries, are often just temporary containers designed to manage liability and tax obligations. The true economic apparatus is the invisible, combined mechanism of control that dictates when the cash actually flows. In corporate finance, the principle of substance must always conquer form to reveal a firm's true engine of value.